If you were to ask a group of income investors, what's the best business development company? Odds are good that Main Street Capital would likely come in first or second. Known for being the gold standard in this sector, Main Street Capital is a company that's well known for its amazing track record. They're one of only a few BDCs that made it through the financial crisis without a dividend cut, and they've never experienced a dividend cut. To date, they've delivered the best share price growth in the whole sector, and they currently have one of the best covered dividends among all BDCs. They're a favorite among fans of monthly dividend stocks, and they've consistently grown it for well over a decade. Main Street Capital has really set the bar high within this sector, and judging by the lack of BDCs willing to pay monthly dividends as well as be able to grow their dividends this consistently, it's sadly clear that many companies just aren't interested in trying to dethrone them. Their stock is one of my largest holdings, and it's actually my best performing investment. But there's been a lot of interest brewing around the news that Main Street recently went public with a brand new business development company that just started trading. MSC Income Fund, ticker MSCF, is a brand new BDC that's being managed by the people over at Main Street Capital. So today I thought we'd take a deep look at this company to see if we can expect the same kind of performance from MSCF that Main Street has provided us. This is MSC's website, which probably looks really familiar because it's identical to Main Street's. Now the truth is, MSC Income Fund isn't a brand new BDC. It's actually been around since 2011. But earlier this month, the company decided to go public with their own public offering. What they did was they basically converted their structure, going from a private BDC to a public BDC. Private BDCs are exactly what they sound like. They function in the same way as a public BDC, only they aren't available on any stock exchange. If you want to invest in a private BDC, you have to call up and work through a broker who will charge fees for their service, and private BDCs usually have some kind of investment minimums. Like you have to be willing to invest at least $10,000 into their fund. They're also not liquid investments, which means it's much harder to sell your shares of this investment if you want to. With that being said, it's usually not worth putting money into these investments, especially if you aren't super wealthy. But going public means that now anyone can buy into MSC. Their ticker was recently added to financial websites, and depending on which one you're using, it likely doesn't have all of the information available yet, or it's not completely accurate. For example, on Seeking Alpha, its stock chart looks a little strange, and Yahoo Finance isn't reporting all of the right numbers, and pretty much all of these websites don't have the correct dividend yield. If we go to the company's website, we can see their last dividend was for 36 cents per share. Multiplying by 4 and then dividing that number by the stock's current share price, we can see MSC is currently offering a yield of about 8.5%. Not exactly great for this sector, but then again, it is much higher than Main Street's yield. Now, unfortunately, there's already one disappointment about this stock, which is that it does not pay monthly dividends. It shows they currently pay quarterly dividends, which is too bad. Now, they could potentially switch to monthly payments someday. It's not common, but some dividend stocks will switch their payment frequency, which is usually just to appease investors. Every private BDC that I've ever come across makes distributions quarterly, so who knows, they could change their payout schedule eventually now that they're a public company. Another key piece of information coming from their website is that this BDC is going to be externally managed by Main Street. When a BDC is externally managed, that means a percentage of their income generated from their assets is going to go to their managing company. Fortunately, their expense ratio is currently one of the lowest in the industry, along with Main Street Capital themselves. So like I said, because MSC isn't brand new, they're just going public, there is a good amount of information that we can take a look at. Both the CEO and the president of this fund were two of the co-founders of Main Street Capital, so they have a lot of experience that they'll be bringing to this company as well. The other executives come from Main Street, but two of them are relatively new additions, joining Main in 2019 and 2020. We'll spend some time comparing some of the most important metrics with both companies to see how similar they're going to be to each other. For starters, we'll compare portfolio sizes. Despite them being a newer company, MSC currently has $1.1 billion in investments. According to SWF Institute, they're currently the 34th largest BDC in the industry when ranked among public and private BDCs. Main Street Capital, on the other hand, currently has over $8 billion worth of investments, so they're significantly bigger. In terms of what sectors they both invest in, I'd say they're pretty similar to one another. Nothing really stands out here, they both avoid cyclical industries pretty well. Now, the most important thing that's made Main Street Capital stand out from nearly all other BDCs is how many equity investments they have in their portfolio. The vast majority of BDCs only hold a very small amount of equity in their portfolios, and usually over 90% of their investments are in debt. Here's an example of the performance of a BDC that's about 98% debt. Their share price doesn't move too much over time. It can, but it'll be much slower compared to a company like Main Street. Now, this is Main Street's performance, who like to take equity stakes in their investments. It is much harder for a BDC to pursue a lot of equity positions. They're riskier than any debt position they could take, like first and second lien debt. With those kind of debt investments, there's a chance they could recover some of their losses if an investment fails. But by the time they get down to equity investors, there's often nothing left to recover. So it does require more research and sometimes a bit more strategy, since equity positions fluctuate in share price. According to their most recent financial results, equity investments make up 26.7% of Main Street's portfolio. Now, according to MSC's latest 10Q, their portfolio is made up of 19.1% equity. I would say that this is more equity compared to what's normal for a BDC, but judging by this metric, I wouldn't expect MSC to be as good of a grower as Main Street. But on the other hand, it does offer a much higher yield with a team that's coming from Main Street. MSC is yielding over 8%, and due to Main Street being so overvalued as of the making of this video, their stock is only yielding around 5%. The next thing we have to look at for both companies is NAV growth. A BDC's NAV is basically the size of their investment portfolio, their assets minus their liabilities. With these investments, I always say that any amount of long-term NAV growth is great, but even if a NAV has been mostly flat or just slightly declining, then that's okay. Because BDCs have to pay out 90% of their earnings to shareholders, they don't get to retain much to grow their portfolios unless they want to issue more shares of their stock. So if a BDC has a lot of bad investments, their NAV is going to shrink, which will make it more susceptible to a dividend cut. The main driver of NAV growth for these BDCs is going to be their equity holdings, and if they're picking good equity investments, that will result in better growth. Main Street Capital has been unmatched when it comes to NAV growth. This is their NAV's performance over the past few years, and you can see they've done really well in growing it. It might not seem like a whole lot, but again, this is actually some of the best growth in the whole sector. If we look at MSIF's NAV, you'll notice they haven't been as great when it comes to growing it. This looks pretty typical for a normal BDC that has a lot of debt investments, so Main is definitely the superior stock in this category as well. In terms of value, both stocks are currently overvalued by the usual BDC metrics, but MSIF is definitely the better deal. Main Street Capital is currently trading at a 92% premium to their NAV, which makes this stock extremely expensive. It's important to know though that this stock is always overvalued. The markets have just been willing to pay a lot more for this company because of its incredible growth. But MSC is only trading at a 9.5% premium, which I think is still slightly too expensive. Considering it just started trading, I think the market is still trying to get a feel for this company. So ultimately, what are we to make of MSC Income Fund? By all accounts, it looks like an average business development company with a couple of exceptions. They do have more equity holdings compared to most of their peers, but not as much as Main Street. So this has me wondering if MSC could be pursuing some kind of blended strategy, like a BDC that offers a higher yield than Main Street, but can still offer some share price growth, but probably not as much as Main Street has. If that is what they're trying to do, their NAV hasn't increased over time. It's unfortunate, but this really does look like a typical BDC. I suppose if you don't already have enough BDCs in your portfolio and you want exposure to the Main Street management team, then MSC could be worth considering. But I don't see anything that would lead me to believe that this stock will outperform their peers. Who knows though, maybe now that they're a public company they'll make some changes. Let me know your thoughts in the comments and if you'll be buying this stock. But with that being said, that's going to wrap up today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.